We're diving straight into an analysis report on CleanSpark, ticker CLSK.
Yep.
The core idea is that its recent drop to $12 is a major investment opportunity based on strong profitability and some really interesting future catalysts.
And the underlying numbers in this analysis are genuinely compelling. I mean, the financial model is incredibly strong. But
But we immediately see a tension, a real disconnect in the presentation style that, it needs to be resolved if this analysis is going to have the impact it deserves.
right, it feels like it's trying to be two things at once. On one hand, you have this institutional grade data. We're talking FY 2025 revenue estimates over $766 million.
Huge numbers.
.net income projections around $365 million, and a forward PE ratio that comes out to what, about 10.8?
Which is just
Almost unbelievable for a growth story.
exactly. But then all of that sophisticated data is wrapped in this highly speculative, very retail-focused language.
Things like golden bullish thesis or the squeeze powder keg.
That blend is the exact point of friction. The report's reliance on high-emotion, speculative framing, well, it risks undermining the credibility of its otherwise powerful fundamental arguments.
I see what you mean. That risk of misalignment is definitely there. But couldn't you argue that if the analysis is going on channels that reward high engagement, you almost need that kind of framing just to get eyeballs on it in the first place?
That's a fair question, but you have to think about what happens after you get that click. What's the priority once someone is engaged?
Okay,
Where the current approach stumbles is that the style, which is, designed for that quick attention grab, it forces the really sophisticated financial metrics to compete with these narratives about momentum and short squeezes.
so the signal gets lost in the noise.
Perfect way to put it. You're making a case built on the fact that CLSK's 10x PE is an absolute anomaly. I mean, high-growth tech stocks usually trade at what, 30x, 50x?
Easily.
That is a devastating, purely mathematical point that should just stand on its own.
It really should.
But instead of letting that data anchor the whole argument, the analysis pivots hard to focusing on these speculative elements like the 33 to 40% short interest.
And the days to cover metric.
Right. And the result is this confusing blend. It might alienate the serious, analytical person who's looking for rigorous data. They see a title like Golden Opportunity and might just dismiss the serious work before they even get to the valuation disconnect.
So the tone doesn't match the discipline of the financial work.
Precisely. The solution isn't to get rid of the momentum stuff entirely, but maybe just to resequence it, reframe it so it supports the fundamental case instead of overshadowing it.
Exactly. So what we'd suggest here is to reprioritize the flow and the language. Let those undeniable financial metrics anchor the entire argument.
And then move the speculative narratives.
Which are still important for a complete picture, yeah, move them to a distinct, clearly labeled section. If the goal is a robust financial analysis, the language just has to reflect that rigor.
Okay, so let's get concrete. How could that be done? For example, with that section on the short thesis?
Sure. So that section is currently titled The Short Squeeze Powder Keg.
Yeah, very evocative.
It is, but I'd suggest reframing it, something more neutral, more analytical, maybe technical positioning and market pressure.
Yeah,
It acknowledges the reality of the situation without the hyperbole.
I like that. And then look at the main title, Golden Opportunity. I mean, you could move away from that and lead with what's really proven here, the valuation disparity. So something like CLSK at $12, analyzing the valuation disconnect.
Exactly. It keeps the excitement that the stock is cheap, but it conveys it with the authority the data actually deserves.
That makes a lot of sense. It professionalizes the argument without losing what makes it exciting. And that actually leads us right into our second observation.
Okay?
We've established the strength of the upside case. The report notes, a 92 to 150% potential upside based on those analyst targets?
Which is huge. But as I recall from the notes, the report labels the risk profile as just high, volatile.
And that's it. It offers almost no specific analysis of what defines that volatility. It's almost entirely focused on the reward side.
So the analysis is incomplete. It's assuming that all the good things will continue, but it doesn't model what happens if they don't.
That is the crux of it. To elevate this from, a promotional thesis to a comprehensive analysis, a dedicated, detailed section on potential headwinds and execution risk is absolutely essential.
I agree we need risk mapping, but wouldn't dedicating a whole section to the contrarian view, give too much airtime to the other side? Isn't a simple warning enough for a bullish thesis?
In high-level due diligence, if you can't articulate the downside better than your opponent, you just haven't finished your homework.
And the homework is only half done here.
Exactly. And where it falls short is glaring, precisely because 33 to 40% of the float is sold short.
When that many smart people are betting against you.
Simply saying high volatile is not enough. The weakness is that a real high-level analysis has to engage with the counter-arguments.
It fails to explore some really crucial, specific downside risks.
It does. For instance, what if the AI pivot, which is a big part of the story, what if it fails to re-rate the stock? Or what if there's major regulatory pressure on mining in North America?
And critically, that $364 million in net income.
Yeah.
That number is completely tied to the price of Bitcoin. And there is zero analysis on what a sustained, severe drop in Bitcoin would do to that projection.
It's an assumed variable, not a modeled risk. And in this sector, that is probably the weakest point of the entire argument.
So the suggestion for improvement is to add a required section. Title it Analysis of Potential Headwinds or maybe Contrarian Thesis.
And in that section,
You have to model specific risks. You have to explicitly detail what conditions could stop CLSK from hitting that $23 average price target. You have to anticipate and dismantle the short thesis, not just ignore it.
that really completes the picture. It considers the full risk-reward spectrum. So what are some concrete examples of risks that should be modeled or outlined?
Well, first, you need to outline the specific assumptions the shorts are making. What are they betting on?
Okay.
For instance, you could model the downside if that AI venture requires way more capital than expected and it dilutes earnings in the short term. Or you could detail exactly how that huge treasury of 13,000 Bitcoin would be impacted in a severe market drawdown.
So sensitivity testing.
Yes, you need sensitivity testing. By addressing those specifics, you show robust due diligence, not just promotion.
That level of detail is exactly what takes a thesis from good to great. Okay, shifting gears a bit, let's talk about the external validation piece we mentioned earlier.
Right, the analyst consensus.
Yeah, the analysis has excellent data there, but the sequencing seems off. It's placed near the end of the report.
And it's really powerful data.
Incredibly powerful. It shows that 11 out of 12 analysts rate CLSK a strong buy. The average price target is $23.27, with a high of $30. That's a huge stamp of approval.
It's tremendous support. But the placement is a problem. The powerful external validation from the Wall Street consensus is currently placed too late in the report, and that just lessens its utility as immediate evidence for the valuation claim.
So why hold your best card until the end? What's the consequence of putting that data near the conclusion?
The weakness is structural. By putting it near the end, the report treats the consensus like a concluding thought, not foundational support.
I see.
So it forces someone to absorb and accept all the internal logic first. You know, the PE of 10.8 implies a $30 stock, before you give them the external proof that professional analysts have already reached similar conclusions.
It's an issue of credibility sequencing. You want to lead with all the authority you have.
Precisely. The suggestion for improvement here is simple. Integrate that consensus data directly into the argument about the valuation disconnect.
So it's right up front. Right up front. It immediately establishes a professional benchmark for the upside, and it lends instant authority to the claim that $12 is a bargain. It makes the internal calculation feel less like a lone wolf's projection and more aligned with the market.
That makes the whole thing feel so much stronger, right from the start. Can you give a concrete example of how someone could weave that external data into the flow?
Absolutely. So in that valuation disconnect section, where the PE of 10.8 is discussed, you explicitly follow that up by noting this internal valuation metric aligns directly with external analyst targets. Then just state the facts. The consensus on Wall Street is a strong buy.
And the average price expectation stands at $23.27, a verifiable 92% upside. You use the analyst validation right when the core thesis is being built, and it makes the case exponentially stronger from the outset.
That restructuring really maximizes the impact of the strongest data points. These three areas, taken together, they would completely transform this analysis.
I agree. The raw fundamentals, the revenue, the net income, the AI pivot, it's all excellent. But the goal here is to make the report bulletproof for any sophisticated person who picks it up.